Nassau County government, then I'm standing here at the Newark Free Library. We're about to hear Chief Administrative Officer David Grimaldi talk to the Newark High School Future Millionaire of America Club, and he's going to talk to them about the stock market and what investments to make. Let's go on in.
My name is David Grimaldi. I'm the CAO of Newcastle County, Delaware. My former life, I used to be a financial advisor at Morgan Stanley. How many of you have heard of Morgan Stanley? Okay, for those that you haven't, it's one of the top 2 investment banks in the world. They're involved in all the big IPO deals. They have some of the best research. Generally, when Morgan Stanley puts out a piece of research, people listen. When I first came, and I'll tell you a little bit about my position first, and then we can go into some stock-specific stuff. My first interview when I went to Morgan Stanley, I was just out of college, and I went in and he said, my interviewer, the sales manager at the time, said, "Why do you want to work for Morgan Stanley?" And then he stopped and he said, "No, wait a second. Why should I let you work for Morgan Stanley?" So it was sort of a tough interview. I pushed through it. I told him that I was ambitious, that I would work for free. He almost took me up on that offer and paid me $30,000 in my first year. But during that time, by the way, most people think that a stockbroker, which essentially is what I was, the term is financial advisor, but essentially a stockbroker. Most people think it's sitting around analyzing stocks all day, but it actually isn't. In the beginning, you're basically a glorified telemarketer, where you get a desk and a phone, and you are told to make a certain amount of phone calls and bring in assets to the company to manage. And you are judged by how much assets you gather and how well those assets do. My first cold call, I remember I picked up the phone and I couldn't get the words out of my mouth. I was stuttering so much that the guy hung up on me. And so I was thinking, wow, this is going to be a tough job. And I really doubted whether or not I could do it. And I saw probably 60 people come through my office just like me. And everybody was gung-ho, everybody was confident that they could do well. They picked up the telephone, they got hung up on, and they gave up. And I'll never forget, I watched the boxer. I don't know, how many of you watch boxing? Well, at the time, Mike Tyson was still, one of the top boxers. And I remember once they asked Mike Tyson, he was coming for one of his upcoming bouts, and they said to him, "Well, what are you going to do about this opponent that you're facing? He seems eager to get his hands on you. He has a plan." And Mike Tyson, in a moment of what I think brilliance, said, "Everybody has a plan until they get hit. Everybody has a plan until they get hit." And it was the same thing on Wall Street. 60 of us came through the door. There was one standing at the end of a year. That was me. And it's because I kept pushing forward. And it's because that every time I got hung up on, I felt that I was closer and closer to somebody saying yes. Generally, the most successful people in the world, when you guys grow up, they get to be that way. Not because they didn't hear no, but because they heard no more than anybody else. If we go through some of the stock market, why do stocks go up and down?
People buy and sell.
Brilliant. Because you get what the media doesn't get. Because every day you'll get an article about the stock market. And they will say that the stock market went up today because the Federal Reserve is expected to buy more bonds, or the stock market went down because people are concerned about home prices. That's really not true. The media just needs something to print. They need a story. The fact is, stock prices go down because there's more sellers that day than buyers. And they go up because there's more buyers than sellers. And stocks generally are driven by emotions. Do you know which 2 emotions are dominant in the stock market? Fear and greed. And because it's emotional, if you look at a stock chart, this is not great. But generally, when you're at the top here, the dominant emotion is greed. Because everybody at this point here, the individual investors, people that are not in the market, believes that this will continue forever. And this is when the institutional, the smart money, the quote-unquote smart money, the people on Wall Street are selling here, while the individual investor is buying. Notoriously, the individual investor is usually wrong. And there's theories on Wall Street that try to gauge what the individual investor is doing so that we can do the opposite, okay? When you are here at the bottom, fear dominates. Nobody really wants to buy. But generally the people that do buy here are Warren Buffett, value investors. And they buy because it's cheap. Just want to make sure. So the most important thing in investing is to separate your emotions from your logic. And it's very, very hard to do. Some of the best trades I've ever made in my life were when I was scared to death to buy. But that's how I know it's right. It's a gut instinct. When you're buying, because everybody's petrified. So in 2008, we were here. Or should I say March 2009. This was a time when a lot of the smart money started to buy real estate stocks. Why? Because they went down for so long. We had a 7-year depression in real estate. That's a once-in-a-lifetime thing, and those stocks got killed. So smart money started buying here. And in 2005, if I back up, and I'll show you this in the charts, something funny happened. The housing stocks, the real estate stocks that were going up for 7 years began to break down. So you had this clearly defined trend line. We'll get into trend lines. But something changed in 2005 where the stock price began to fall. At that time, the research firms on Wall Street started to say problems are coming in the housing market. Do you guys know that stocks are a leading economic indicator? So a lot of times the media makes a mistake and they'll ask an economist what you think about the stock market. And that's fundamentally wrong. You can ask a stock guy what he thinks about the economy because stocks will lead the economy. So when I saw this in 2005, we knew that the housing market was in trouble. And about a year later, the housing market began to collapse. It's because stocks are a leading economic indicator. It's very important to know. By the way, another example was in October of 2007, the stock market began to collapse. And it was a year later that the National Bureau of Economic Research came out and they said, you know what, the country's in a recession. It took them a year to figure out that we were in a recession. This is after the stock market already collapsed 50%. That's a great job. I would love to work for them because they're predicting something that already occurred. Another funny thing is during the government shutdown, you guys remember that? Mm-hmm. Recently, stock prices began to come down. And then one morning, where the stock market was going like this, one morning we opened up 130 points. I remember saying to somebody, they have a deal. And a few hours later, the deal was announced. Why does that happen? Because you like to think, and there's assumptions on Wall Street that show that there's perfect information and everybody has the same information. That's generally not true. It's generally that information gets out and people act on that information. So when you see that the stock market opened up 130 points on that day, we knew that there was a deal, that they already had a deal. And in fact, that was announced a few hours later. And another word about the individual investor. Do you guys know who John F. Kennedy is, I'm sure? Okay, do you know who his father was? Joe Kennedy. Joe Kennedy, one of the most famous stories on Wall Street is the shoe shine story. Joe Kennedy was a stock market investor. At the time, he was worth about $50 million in today's terms, dollar terms. And he went to get a shoe shined, and the kid shining his shoes, a 14-year-old kid, was telling him about investing in the stock market and how much money he can make. and he gave him a stock tip. And Joe Kennedy, who was known, I think, to be somewhat frugal, gave him a really good tip. And he said, "Thank you, son." He went back, he called his broker, and he sold everything. And he sold everything, all the stocks, because he said, when the shoeshine boy is telling me about the stock market, it's time to get out. It's time to get out. And his wealth, Joe Kennedy's wealth, went from $50 million in 1929 to $2.8 billion in today's terms by 1935, during the Great Depression. And the reason is he shorted the stock market during the Great Depression. Do you guys know what that means? To short it?
Buying credit.
It's not buying on credit, you're selling on credit. So you're selling the market first, and you're borrowing the shares. So essentially, you're betting that the stock market's going down. So he did that. And is there an erase button? So So 1929, the market's going up, starts to collapse, and Joe Kennedy decides to short the market. Market goes straight down, loses about 90% of its value. Because he knew that back then, when a stock is moving down, other institutional investors, big money, can come in and start shorting it and pile on and drive the stock price all the way into the ground. And he saw that there was a fundamental flaw in that. Although he exploited it and he made a lot of money, Joe Kennedy went on to be the first chairman of the Securities and Exchange Commission. And one of the first things that Joe Kennedy did is he put in a rule called the zero uptick rule, which said, you can't do this. You can't pile on and short a stock into the ground until there's some buying activity, until it ticks up. If you have a tick up, then you can sell it. But if there's no tick up, you can't do that, because he realized there was huge threats to the financial system if everybody was allowed to come in and short the stock into the ground. So essentially, he closed the loophole that made him rich. Joe Kennedy did. And that prevented a catastrophic systemic problem like we had in 29 for 70 years. That zero uptick rule was removed in 2007. And in 2008, we got another 1929-esque kind of a crash. And it's still the case. And the reason is hedge funds predominantly do this. They make a lot of money doing that. And if you can do this without this exploit, there's a lot of money to be made, and they did. If you know who Hank Paulson is, Hank Paulson is the guy that made a couple $1 billion a year, I think it's $4 billion, by shorting the mortgage market. And he shorted it into the ground, just like that. He made $4 billion, but the system collapsed. And this is still the case. That exploit still exists today, and it's still vulnerable. Okay, so there's two types of analysis. Let me just get this off. And if anything I say is too technical, just stop me. So you have fundamental analysis. And you have technical analysis. Fundamental analysis will tell you what to buy. Technical analysis tends to tell you when to buy. Fundamental analysis will focus on things like price to earnings ratio. Have you guys gone into that yet? Okay. So you have two stocks, right? Stock A, stock B. And let's say one of them is worth trading at $50 a share. The other one's trading at $30 a share. Which one's cheaper? It's a trick question.
it doesn't matter because maybe you want to spend $100,000 on either of those shares, but you're going to get the same amount of money. Your stocks are going to work the same, so none of them is cheaper.
This guy has a lot of money. Okay, so actually, you need more information to answer the question. So if I tell you this, if I tell you that this stock earns $10 per share, that's called EPS, earnings per share. And this stock earns $1 per share. Which one's cheaper? When you buy a stock, you're essentially paying for earnings. Okay? So this stock trades at 5 times earnings. That would be the PE. And this stock trades at 30 times earnings. So actually, the higher share price value is actually cheaper. Okay, and you know, generally 15 is the cutoff times earnings. So if it's trading at 5 times earnings, that's considered cheap. And if it's trading at 30 times earnings, that's considered expensive. But it's also considered a growth stock. It may be trading expensively because people expect that this number is going to grow substantially. And remember one thing, Wall Street pays for growth. They pay for growth. They want to see that sales are growing every year, and they want to see that profits growing every year. And they will pay up for it. They will pay up for it even if the company doesn't have earnings. There was a huge IPO just came out of Twitter. And Twitter has no earnings. So the question is, how do you value a stock using fundamental analysis that has no earnings? Well, you got to look at something else. You look at, you know, price relative to sales, or price relative to its book value, because there's got to be some other mechanism to gauge. Now, technical analysis began with Charles Dow. He was the father of modern technical analysis, and he was a reporter who was following the stock market in the late 1800s, and he would knock on different corporations' doors and say, you know, tell me how your business is doing. And they would say, go away. It's none of your business. Because this is prior to the establishment of the SEC and all the requirements for reporting. Back then, they didn't need to report anything. There was very little reporting. So what he did is he noticed that there was a correlation between stock price movements and the economy. And so he took 12 stocks and he created an index. It's called the Dow Jones Industrial Index. And based on those 12, by the way, the original Dow Jones in 1880 had 12 stocks. There's only one of them that's still in the stock market in the Dow Jones Industrial Average today. Do you guys know which one? Want to take a guess?
Gold.
It's not a stock. Close. General Electric.
Oh.
General Electric was in the original Dow Jones and it's still there today. But Charlie Dow said, okay, these are the makers of goods. So we're going to also create an index for the shippers, the movers of goods. Today that index is called the Transportation Index, but it used to be called the Dow Jones Railroad Index. And he devised a theory that said, if the economy is truly in good shape, then both of these indexes should confirm one another. If the economy is strong, then the makers of goods, their stocks should be going up, and the shippers, the movers of goods, their stocks should be going up as well. And if that happens, he calls that a primary bull market, meaning bull market means stocks are going up, and he would say that that can give you some indication where the economy is going. So whereas fundamental analysis is focused on earnings and financial statements, technical analysis is focused primarily on stock prices, stock movements, and patterns. And I can get on the, if I get on the projector, I can show you some of the patterns in the market, and we can go through individual stocks too, if you guys like. All right.
We're here at Newark Free Library, which is an integral part of the county library system. And with me is Chief Administrative Officer David Grimaldi. We have Diana Brown, who is with our Department of Community Services. She oversees all of the libraries. And we have Mike Costantino. He's a teacher at Newark High School. Mike, what do you teach at Newark High School?
I teach economics, AP Euro, also some U.S. history, so kind of the whole gamut.
Excellent. Now, David Grimaldi was here to talk to the Future Millionaires Club about the stock markets. David, a lot of people know by now that you were a former financial advisor with Morgan Stanley on Wall Street. You know, that was the big time. And I think a lot of people might not know that you came to Delaware to turn around the financial fortunes of the Crown Plaza Hotel in Claymont, correct?
Yes, I did. My next company owned an asset that was really underperforming. The year before I got there, I lost $1 million. The first year I was there, we broke even, and by the second year, we were making money again. So yes, yep.
Excellent. So this guy knows what he's talking about when it comes to the stock market. And Diana, I want you to talk a little bit about how this all came together, with Newcastle County working with our neighbors, Newark High School, and I believe you mentioned UD was involved. Tell us a little bit about how we brought David here to talk to these kids about the stock market.
All right. Well, first of all, we hear a lot about financial literacy today and how important it is and how undereducated many people are. So our department decided to partner with the UD Center for Education and Entrepreneurship and Newark High School to put together a program for students to teach them how to actually learn to trade in the stock market. And it's been underwritten by some grants, so they're getting real cash to place their investments, and that's why we're here. And we thought no one better than David to come and talk to the kids.
All right, now Mike, talk a little bit about bringing the CAO of Newcastle County government to talk to the kids that you work with in this club, and what that's like for them as they try to learn the ins and outs of investing. Particularly if they want to be future millionaires.
Okay. The big thing was getting somebody who knew what they were talking about. Obviously, his experience was a big thing. So. Someone who is very experienced, trying to get the kids to have as much real-life knowledge as possible, and just hopefully helping them be successful.
Now, David, I wanted to ask you about you coming out to talk to the students. As I said before, it's great when the government can come out and be in touch with the community. You had an enthusiastic group here. They asked some really good questions after you talked about stock market, and how stocks can go up and down. And I didn't know they can go sideways too. Talk a little bit about doing things like this out in the community.
Oh, it was really my pleasure, and I have to thank you, Mike. This is a great group. They were very inquisitive. They asked a lot of great questions. They really surprised me, and I think at least one of these future millionaires are actually going to be millionaires when they grow up.
I'm here with a couple of the members of the Newark High School Millionaires Club, and to my left we have
Brett Zuccarelli.
And on my right,
Tristan Graham.
All right, so I wanted to ask you guys, David Grimaldi told you some of the tips that he could share with you about investing in the stock market. Stocks can go up, they can go down, they can go sideways. What did you think about some of the things you learned today, and how do you think that'll help you as you, begin this project and decide how you're going to invest?
I got a little scared. We're learning a lot of things. There's a lot of things to consider today. I would definitely say we learned about how other things can influence outside of the stocks. There's a lot of media that affects the stocks, and that all has to be taken into consideration.
All right.
I think it's important to look at the trends. You want to draw a line and see if there's a breaking point on when to sell and when to buy. Also, I think it's cool to look into their buying and see how much it costs, because that can be a killer in your gains and falls.
Yeah, speaking of that, one of the things the CAO talked about was, being willing to take risk in the stock market. That's a big part of the game. It's almost like you have to have a gut feeling about a stock, not to mention all the hard work and research that goes into it. What do you think about that part of it? It kind of goes to what you were talking about. It's a little scary. Do you take that advice to heart, in terms of having to go out on a limb sometimes with the stock market?
I think it's pretty hard to predict, but if you do your research, if you really look at the charts and everything, if you pay attention to all the little signs, I think you could I think there's some money to be made.
All right. What about you, man?
I had a couple of gut feelings about stocks, but then I decided to not invest them in our simulation game, and then they decided to go up. So I'm going to trust my gut in the future. And also, I wish I knew about investing in $2 stock, or not investing in $2 stocks before I did that, because now I want to look in the $5 to $16 price range. And also, I think it's important to look in the market cap value of the company for the year.
All right. Well, I know that CAO David Grimaldi wishes you best of luck as you start this project. And here's to your future successes as millionaires. Well, there you have it, folks. Keep it tuned here to NCCTV for all your news and information on county government.